The 7 Golden Principles of Smart Investing, audiobook for building wealth, written by Peter A. Saul, published by Audiobooks, LOA. Welcome. Are you ready to move beyond financial uncertainty, beyond just getting by, and start building real, lasting wealth? Maybe you're looking at your savings account, seeing the numbers creep up slowly, but feeling that deep down sense that your money could be doing more, working harder for you. Perhaps you've heard about investing, the stock market, maybe real estate. Perhaps you've even tentatively dipped your toe in, maybe bought a few shares based on a tip, only to feel overwhelmed by the jargon, the flashing numbers on the screen, the sheer noise and contradictory advice flooding the internet and airwaves. You hear advice from all corners. Maybe you tune into popular financial personalities, perhaps catching the Dave Ramsey Show live or listening to the Dave Ramsey podcast. You hear passionate calls to action, focusing heavily and rightly so for many on the critical first steps, getting out of debt using methods like the debt snowball, meticulously crafting a budget, getting absolute control over your money, and cash flow, finally cutting up that nagging credit card and ensuring you have the right insurance safety nets in place. This groundwork is essential. You absolutely need that solid foundation. Paying off high-interest debt provides an immediate guaranteed return, far exceeding what most investments can promise safely. Building a solid budget is like giving your money a job description. But what comes next? Once the consumer debt is gone, the emergency fund is built and the budget is humming along. How do you truly shift gears from financial stability to significant wealth building? How do you harness the power of the markets to grow your assets substantially, moving towards genuine, lasting financial freedom? How do you learn how to make money from your money? That transition from diligent saver and debt manager to savvy investor is precisely what we're going to navigate together in this audiobook. My name is Your Name or Remain Anonymous as the guide, and I've dedicated years to understanding the intricacies of finance, not just the theories, but the practical application, the behavioral pitfalls, and the proven strategies that stand the test of time. I've experienced the journey myself, from uncertainty to clarity, and I've had the privilege of guiding others along their own paths. Think of me not just as an expert citing data, but as an experienced mentor, here to provide calm, clear direction, based on what truly works. Our mission here is to cut through the often intimidating complexity of investing. We will distill the collective wisdom of some of the world's most successful and respected investors. Legendary figures like Warren Buffett, whose patient, value-driven approach is iconic, and John Bogle, the pioneer who democratized investing for millions into 7 golden principles of smart investing. These aren't trendy hacks or speculative gambles you might see hyped online. They are foundational, time-tested strategies, and just as importantly, enduring mindsets that separate successful long-term investing from frustrating guesswork. This investment audiobook is designed for you, whether you're standing at the very beginning, perhaps feeling nervous about making your first investment, wondering how to invest wisely with the goal of one day buying a house free and clear or securing a comfortable retirement. It's also for you if you're an intermediate investor, maybe already contributing to a 401k or experimenting with stocks, but looking to level up your strategy, refine your approach, and crucially, learn to avoid costly emotional decisions. Driven by market swings, we will explore proven methods for analyzing potential investments, techniques for cultivating a disciplined investing mindset, and the profound impact of core concepts like diversification, patience, understanding intrinsic value, and the incredible engine of compound interest. We'll learn how to filter out the distracting market noise and stay laser-focused on the fundamentals that drive real wealth building. Consider this more than just a typical book summary you might find on BookTube. This is structured as a practical guide, optimized specifically for listening, for absorption, and most importantly, for empowering you to take confident action. Are you ready to invest in your financial intelligence, build a robust framework for smart investing, and take meaningful steps towards the financial freedom you deserve? Excellent. Let's begin. For more information about the ebook of this audio, visit video book description. We noticed that 85% of you who listen to our video are not yet subscribed to the channel. Please help support the channel by hitting the subscribe button and like the video. Thanks for inspiring us to create more content for you. Now let's begin. Chapter 1. Principle 1. Think long term. We begin with the cornerstone, the absolute bedrock upon which all enduring wealth building through investing is constructed. It's a principle that sounds deceptively simple, almost cliché, yet its consistent application separates the successful from the frustrated. Principle number 1 is this: think long term. In our modern world, we're constantly bombarded with messages of immediacy, instant news, instant communication, next-day delivery, microwave meals. This culture spills over into finance, fueling the allure of get-rich-quick schemes, day trading promises, and speculative bubbles. Against this backdrop, consciously choosing to adopt and maintain a long-term investing perspective is perhaps the single most powerful and often the most profoundly challenging mental shift an investor can make. But it's the only path that reliably works for building substantial wealth over time. So why is thinking long-term not just advisable, but fundamentally essential for smart investing? The primary engine behind long-term wealth creation is the remarkable phenomenon known as compound interest. You've likely heard the term, maybe even seen calculations related to retirement savings, but let's truly internalize its power. Albert Einstein is often quoted as calling it the eighth wonder of the world, stating, "He who understands it earns it, he who doesn't pays it." Compound interest is, quite simply, earning returns not just on your initial investment, your principal, but also on the accumulated interest or returns from previous periods. It's interest-earning interest. Imagine pushing a small snowball down a long, snowy hill. Initially, it picks up just a little more snow with each rotation. But as it grows larger, each rotation gathers significantly more snow. Its growth accelerates. That's compound interest working on your money. Initially, the growth seems slow, almost imperceptible. Years 5 through 10 show more growth than years 1 through 5. Years 20 through 30 can potentially generate more growth than the first 20 years combined. This accelerating power only manifests significantly over extended periods. Trying to jump in and out of the market short-term completely negates this powerful patient force. Contrast this with simple interest, where you only earn returns on your original principal. A $10,000 investment earning 5% simple interest earns $500 every year. With compounding at 5%, that same $10,000 earns $500 the first year. The second year, it earns 5% on $10,500, which is $525. The third year, it earns 5% on $11,025, and so on. The difference seems small initially, but over 20, 30, or 40 years, the gap becomes enormous. This is the mathematical magic you harness by staying invested long-term. Historical data, while not guaranteeing future results, illustrates this. Over many decades, broad stock market indexes like the S&P 500 have delivered average annual returns significantly higher than inflation. But that average smooths out years of negative returns and years of stellar returns. Trying to predict the stellar years and avoid the negative ones is a fool's errand for most. Staying invested through the fluctuations allows you to capture the average long-term growth powered by compound interest. Let me share a quick story from my early days. When I first started investing, transitioning from just diligently trying to save money from my budget each month, I was glued to the financial news. Every market dip, every negative headline sent a jolt of anxiety through me. I'd check my small portfolio multiple times a day. If it was down, my mood soured. I questioned my decisions. If it was up, I felt a fleeting sense of genius, tempted to sell and lock in the tiny gain. It was emotionally exhausting and completely counterproductive. I remember one particular market correction early on. I panicked and sold a portion of my holdings, convinced things were going to get much worse. I locked in a loss, and then, inevitably, the market recovered, and I'd missed out on the rebound because I was sitting on the sidelines in cash, too scared to get back in. The lesson was painful, but invaluable. True wealth building isn't achieved by trying to outsmart the market's daily gyrations. It's achieved by choosing sound investments based on solid principles, which we'll cover, and then having the discipline and patience to let time and compounding do their heavy lifting. Think about your most significant financial aspirations. Is it achieving financial freedom, where your investments generate enough income to cover your living expenses, freeing you from reliance on a traditional job? Is it funding a comfortable, multi-decade retirement? Is it leaving a legacy for your children or grandchildren? Is it the major milestone of buying a house, perhaps making a substantial down payment, or even paying for it entirely with investment growth? These are almost universally long-term goals. They require years, often decades, of consistent effort and growth. Doesn't it make sense, then, that your investment strategy should align with that same long-term horizon? Trying to fund a 30-year retirement goal with a short-term trading strategy is like trying to build a skyscraper on a foundation made of sand. You might be thinking, but what about the risks? What if the market crashes right when I need the money? That's a valid concern, and it highlights why your investment time frame is so crucial. Money you know you'll need in the short term, say for a house down payment in 2 years, or your emergency fund, generally shouldn't be exposed to the volatility of the stock market. That money belongs in safer, more stable vehicles like high-yield savings accounts or short-term bonds. Long-term investing is specifically for goals that are 5, 10, 20, or more years away. Over these longer periods, history shows that markets tend to recover from downturns and resume their upward trajectory, driven by economic growth and innovation. Acknowledging risk is vital, and we manage it through other principles like diversification, but time is the greatest mitigator of short-term volatility risk. So, the first and most crucial action step is internal. It's a mindset shift. Before making any investment, ask yourself this critical question. Based on my understanding of this investment and my overall financial plan, am I comfortable holding this through potential market ups and downs for at least 5 years? Ideally, 10 years or longer. If the honest answer is no, if you feel the urge to sell, if it drops 10% next month, you might be drifting into speculation rather than long-term investing. Reflect also on your current financial goals. List them out. Estimate their time horizons. Does your current approach to saving and investing align with those timelines? Are you treating your investments like seeds you're planting for a future harvest, or like lottery tickets you hope will pay off tomorrow? Key takeaway for this chapter: patience isn't just a virtue in investing. It's a prerequisite for harnessing the immense power of compound interest. Embrace the long-term investing mindset. Let time be your greatest ally. Focus steadfastly on your distant financial horizon, whether that's financial freedom, retirement, security, or that dream of buying a house, and resist the siren song of short-term market noise. This foundational perspective underpins every other principle of smart investing and is essential for transitioning from merely managing money to actively participating in meaningful wealth building. Chapter 2. Principle 2. Understand what you own. All right, let's move to our second golden principle, one that sounds like common sense but is remarkably often ignored in the heat of investment decisions. It's this: understand what you own. This goes far beyond simply knowing the name of the stock or mutual fund you bought. When you purchase a share of stock in a company, let's say Apple or Procter & Gamble or a smaller local business that's publicly traded, you are not merely buying a digital ticker symbol that bounces around on a screen. You are, in fact, purchasing a tiny, fractional ownership stake in that actual operating business. Let that sink in. You are becoming a part owner. Think about it in a more tangible context. Imagine your friend comes to you, excited about opening a new coffee shop. They ask you to invest $10,000 for a small percentage of the ownership. Would you hand over your hard-earned cash without asking some serious questions? Of course not. You'd want to see their business plan. You'd ask, how do you plan to attract customers? What are your projected costs for rent, beans, staff? Who is your competition? What makes your coffee shop unique? How exactly do you plan to make money? And when do you expect to become profitable? You'd want to understand the business fundamentally before becoming a part owner. Yet, every day, countless individuals, often intelligent people, put significant amounts of their money into the stock market based on flimsy reasoning, a hot tip from a neighbor, a compelling but superficial news headline. This stock is set to soar, or simply because the price has been going up recently, a phenomenon known as chasing performance. They essentially invest in businesses they know almost nothing about, violating the very common sense they'd apply to investing in that local coffee shop. This is a recipe for anxiety and poor decision-making, especially when market conditions inevitably turn volatile. If you don't understand why you own something, how can you possibly have the conviction to hold it? Principle 1. When the price drops. So what does understanding what you own truly entail in the context of investing? It means digging beneath the surface, beyond the stock price. It means developing a basic comprehension of the business model. How does this company actually generate revenue and profit? What specific products or services does it sell? Who are its primary customers? Is its revenue recurring, like subscriptions, or transactional? A company selling essential software on a subscription basis likely has a different risk and stability profile than a company selling luxury goods sensitive to economic downturns. Competitive landscape and moat. What prevents competitors from eating this company's lunch? Does it have a sustainable competitive advantage? What legendary investor Warren Buffett, borrowing from Pat Dorsey, famously calls an economic moat? This moat could be a strong brand, like Coca-Cola, network effects, like Facebook, Meta, eye-switching costs for customers, like certain enterprise software, unique patents, or significant cost advantages. A company without a moat is vulnerable. Management quality. Who is running the show? Does the leadership team have a track record of competence, integrity, and smart capital allocation? Do they communicate clearly and honestly with shareholders? Are their interests aligned with yours as an owner? Evaluating management is subjective, but crucial. Look for consistency, transparency, and a focus on long-term value creation, not just short-term hype. Be wary of excessive executive compensation or a history of poor decisions regarding acquisitions or managing debt. Financial health. You don't need to be an accountant, but a basic understanding is key. Does the company generate consistent profits and positive cash flow? How much debt does it carry relative to its equity or earnings? Is it manageable? Companies overloaded with debt are inherently riskier, especially when interest rates rise or business slows. Look for trends. Are revenues and profits generally growing? Industry dynamics and risks. What are the major trends and potential headwinds facing the industry this company operates in? Is it a growing industry or a declining one? Is it vulnerable to technological disruption, regulatory changes, or shifts in consumer preferences? Understanding the broader context is vital. This applies whether you're investing in tech, healthcare, energy, consumer staples, or even companies involved in real estate development or management. Now, reading that list, you might feel a wave of overwhelm. This sounds like a full-time job. I'm just a beginner trying to save for the future, maybe buying a house someday. I don't have time to become a financial analyst for every stock. That's a perfectly valid feeling. And here's the good news. You don't need to be an expert analyst, and you certainly don't need to understand every company or every industry. The key is Warren Buffett's concept of the circle of competence. Invest primarily in businesses and industries that you can reasonably understand, leveraging your existing knowledge as a consumer, employee, or hobbyist. If you work in healthcare, you likely have insights into healthcare companies. If you're a tech enthusiast, you might understand software or hardware businesses better than average. If complex biotechnology or intricate financial engineering companies feel like a foreign language, it's okay to avoid them. There are thousands of publicly traded companies. You only need to find a manageable number of good ones that fall within your circle of understanding. Stick to what you know and gradually expand your circle over time through learning. Principle 7. Furthermore, this principle applies differently if you invest primarily through mutual funds or ETFs, exchange-traded funds, which many people do, especially when starting or aiming for broad diversification. In this case, understanding what you own means understanding the fund's objective, strategy, and underlying holdings. What kind of companies does this fund invest in? Is it focused on large U.S. companies, international stocks, bonds, specific sectors like technology or real estate, through REIT funds? What are its fees? Understanding the fund's mandate helps ensure it aligns with your goals and expectations. Does it fit into a sensible framework, like perhaps aiming for the 4 types of funds often discussed for basic diversification, like U.S. stocks, international stocks, bonds, and potentially REITs? Even with funds, a basic grasp of the strategy is crucial. So how can you put this principle into practice? Start with 1. Pick one investment you currently own or are considering. Commit to spending just 30 to 60 minutes researching it. Can you clearly articulate in simple terms how this company makes money? Who are its main competitors? What's one major risk it faces? Visit the source. Go to the Investor Relations section of the company's website. Look for the latest annual report or an investor presentation. You don't need to read every page, but skim the CEO's letter and the business overview sections. It's often written in plain English. Explain it. Try explaining the investment to a friend or family member who knows nothing about it. Can you make a clear case for why it's a potentially good long-term holding based on its business fundamentals? If you struggle to explain it simply, you might not understand it well enough yet. Fund fact sheets. If you own funds, pull up their fact sheets or prospectuses, usually available online. Understand their investment objective, top holdings, and expense ratio. Does it match what you thought you owned? Key takeaway for this chapter: elevate your approach from merely buying ticker symbols to becoming a knowledgeable part owner of businesses. Understand what you own. This fundamental understanding of the business model, competitive position, management, basic financials, and industry builds the conviction needed to hold through volatility. Principle 1 forms the basis for assessing value. Principle 4 helps you avoid emotional decisions. Principle 5, and ultimately leads to more rational and successful long-term investing. Don't treat the stock market like a casino. Treat it like a market of businesses. This investing mindset is crucial for sustainable wealth building. Chapter 3. Principle 3. Diversify intelligently. Let's move on to our third principle, which acts as your primary shock absorber on the often bumpy road of investing. It's a concept widely talked about, but sometimes misunderstood or misapplied. Principle number 3 is diversify intelligently. You've undoubtedly heard the age-old wisdom, don't put all your eggs in one basket. In the context of managing your money and pursuing wealth building, this isn't just folksy advice. It's a cornerstone of prudent risk management. Diversification at its core simply means spreading your investment capital across a variety of different assets so that the poor performance of any single investment doesn't have a catastrophic impact on your overall portfolio. It's about building resilience. Think of building a sturdy table. If it only has one central leg and that leg gets kicked or breaks, the entire table crashes down. But if the table has 4, 6, or even more legs spread out, one wobbly leg might cause a slight tilt, but the table itself remains standing and functional. Diversification provides those multiple points of support for your financial future. Now, intelligent diversification goes beyond just owning a large number of different stocks. Owning 50 different technology stocks, for instance, might feel diversified, but if the entire tech sector faces a downturn, your whole portfolio could suffer significantly. True, intelligent diversification involves spreading your investments across different types of assets and categories that tend to react differently to various economic conditions and market events. This concept is related to correlation. Ideally, you want to own assets that don't all move perfectly in sync. When some are down, others might be up or stable, smoothing out the overall journey. Here are the key dimensions of intelligent diversification across asset classes. This is the most fundamental level. The main asset classes include stocks, equities. Ownership shares in companies historically offer the highest potential for long-term growth, but also come with higher volatility. Bonds, fixed income, essentially loans you make to governments or corporations, paying you periodic interest, generally considered less risky than stocks and can provide stability, especially during stock market downturns. Bond prices can still fluctuate, particularly with interest rate changes. Real estate, investing in physical property, or more commonly, for portfolio diversification, through real estate investment trusts, REITs, companies that own and operate income-producing real estate. REITs trade like stocks, but offer exposure to the property market. Cash and cash equivalents includes actual cash, money market funds and short-term CDs. Offers safety and liquidity, but minimal growth potential, often losing purchasing power to inflation over time. Useful for emergency funds and very short-term goals, sometimes includes alternatives like commodities, private equity, etc., but these are generally for more sophisticated investors. The mix between these asset classes, your asset allocation, is arguably the single biggest driver of your portfolio's overall risk and return profile. Within asset classes, specifically stocks, geographic diversification. Don't limit yourself only to companies in your home country. Investing internationally in developed markets like Europe and Japan, and potentially emerging markets like China, India, Brazil, provides exposure to different economic cycles, growth opportunities, and reduces home country bias risk. Industry, sector diversification, spread investments across various sectors of the economy, technology, healthcare, financials, consumer staples, everyday goods, consumer discretionary, non-essentials, energy, industrials, utilities, etc. Different sectors perform well at different times. Company size. Diversification include a mix of large-cap stocks, large established companies, mid-cap stocks, medium-sized companies, and potentially small-cap stocks, smaller companies, with higher growth potential but often higher risk. Now, you might hear some arguments against broad diversification. Some highly successful investors, most notably Warren Buffett, have built immense wealth by concentrating their investments in a relatively small number of companies they understand extremely well. Principle 2. This can lead to spectacular returns. If you possess exceptional analytical skill, deep conviction, and perhaps a bit of luck. However, concentration also magnifies risk exponentially. If one of your few large holdings falters significantly, your entire portfolio takes a major hit. For the vast majority of individual investors, including beginners establishing their foundation and intermediate investors aiming for steady, long-term growth towards goals like financial freedom or buying a house, intelligent diversification is a far more prudent and reliable path. It's a strategy that acknowledges we don't have perfect foresight. It prioritizes managing downside risk and achieving consistent, sustainable growth over chasing the highest possible short-term gains. It helps you sleep better at night, which in turn helps you stick to your plan. Principle 5. Some critics also talk about diversification, owning too many investments, especially too many similar ones, like dozens of overlapping mutual funds, leading to mediocre returns and unnecessary complexity. The key is intelligent diversification, a meaningful exposure to genuinely different sources of risk and return, not just collecting assets haphazardly. So how do you, as an individual investor, achieve this practical diversification without needing a complex spreadsheet and hours of analysis? For most people, especially when starting or preferring a simpler approach, low-cost, broadly diversified index funds or exchange-traded funds, ETFs, are powerful tools. These funds are designed to track a specific market index automatically, giving you ownership in hundreds, sometimes thousands, of underlying securities across various dimensions. For example, a total U.S. stock market index fund gives you exposure to large, mid, and small-cap U.S. companies across all sectors. A total international stock market index fund provides geographic diversification across developed and emerging markets outside the U.S. A total bond market index fund gives you broad exposure to investment-grade U.S. bonds. A REIT index fund offers diversified exposure to the real estate market. Combining these types of funds in appropriate proportions based on your risk tolerance and time horizon creates a highly diversified portfolio easily. You might hear financial advisors or resources like The Ramsey Show mention frameworks like the 4 types of funds I invest in, often referring to a simple, understandable mix similar to the examples above, e.g., growth stock, growth and income, stock, aggressive growth stock, international stock, though index fund equivalents often provide broader, lower-cost coverage. While the specific fund types recommended might vary slightly between philosophies, the underlying principle of spreading risk across different fundamental categories, U.S. stocks, international stocks, bonds, potentially real estate, is the common thread of intelligent diversification. The crucial step is determining an asset allocation, the percentage mix between these broad categories that aligns with your personal situation. A younger investor with a long-time horizon might have a higher allocation to stocks, while someone nearing retirement might have a larger allocation to bonds for stability. Assess your current portfolio. Take an honest look at your current investments, including retirement accounts like 401ks or IRAs. How diversified are they really? Are you heavily concentrated in one stock, one sector, or just your home country? Tools like Morningstar's Instant X-ray, often available through brokerage platforms, can help analyze your overall exposure. Define your target allocation based on your long-term goals, like financial freedom or buying a house decades from now. age and comfort with risk. Determine a target mix between major asset classes, stocks, bonds, possibly real estate REITs, holding some cash for emergencies. You can find general guidelines online, but consider consulting with a fee-only financial advisor if unsure. Choose your tools. Decide how you'll achieve this diversification. Will you use individual stocks, requiring more research and effort? For proper diversification, broad market index funds, ETFs, simpler and often more effective for most, or actively managed mutual funds, which aim to beat the market but often charge higher fees and may not succeed. Implement gradually. You don't need to overhaul everything overnight. You can gradually shift your portfolio towards your target allocation over time, especially with new contributions. Key takeaway for this chapter: intelligent diversification is your best friend in managing investment risk. It's not about eliminating risk entirely, which isn't possible if you want growth, but about ensuring that no single event can derail your entire long-term financial plan. Build a resilient portfolio by spreading your investments across different asset classes, geographies, industries, and company sizes. Use low-cost index funds, ETFs, for easy and effective implementation. Remember, diversification protects you from the unpredictable, allowing you to stay invested, Principle 1, and benefit from long-term market growth on your journey towards financial freedom and significant wealth building. It's a key pillar of smart investing. Chapter 4. Principle 4. Focus on intrinsic value. We now arrive at principle number 4, a concept that lies at the very heart of the value investing philosophy, famously practiced and preached by giants like Benjamin Graham and his star pupil Warren Buffett. This principle requires a shift in perspective, moving beyond the immediate noise of the market to something more fundamental. Focus on intrinsic value, not just price. In essence, this principle asks you to differentiate between the price of an asset, what it happens to be trading for in the market at any given moment, and its underlying fundamental worth, known as its intrinsic value. The market price is often influenced by short-term sentiment, news cycles, herd behavior, and countless other factors that may have little to do with the long-term earning power of the underlying business. Intrinsic value, on the other hand, is an attempt to estimate what a business is truly worth, based on its tangible and intangible assets, its ability to generate cash now and in the future, and its growth prospects. Think about shopping for anything significant, maybe even the process of buying a house. The asking price set by the seller is just one data point. You, as a potential buyer, would try to determine the property's value based on factors like its location, size, condition, comparable sales in the neighborhood, comps, potential rental, income, and necessary repairs. You assess its fundamental worth before deciding if the asking price is reasonable, a bargain, or inflated. You wouldn't just pay any price simply because the seller asks for it, or because other houses in the area seem to be selling quickly. You'd aim to buy at a price you believe is at, or ideally, below your assessment of its fair value. Investing in stocks should ideally follow a similar logic, though assessing the intrinsic value of a business is more complex than assessing a house. The stock market constantly presents you with prices for ownership stakes in thousands of companies. These prices can gyrate wildly based on daily news, economic forecasts, analyst upgrades or downgrades, or simply widespread fear or euphoria, which we'll tackle directly in Principle 5. Intrinsic value estimation tries to cut through that noise. While there's no single, universally agreed-upon formula, analysts typically estimate it by looking at assets. What does the company own, factories, patents, cash, minus what it owes, debt? This gives a baseline book value, earnings power, How much profit does the company reliably generate? What is the quality and sustainability of those earnings? Cash flow generation. Businesses run on cash. How much free cash flow, cash left over after operating and investing in the business, does the company produce? This cash can be used to reinvest for growth, pay dividends, buy back shares, or pay down debt. Discounted cash flow, DCF analysis, is a common, though complex method trying to value a company based on the present value of its expected future cash flows. Growth prospects. What are the realistic opportunities for the company to grow its earnings and cash flows in the future? The goal isn't necessarily to calculate a precise number down to the penny. Even professionals arrive at different estimates. The real goal is to develop a reasoned judgment about whether a company's stock is trading at a significant discount to its likely fundamental worth. This difference, the gap between the estimated intrinsic value and the current market price, is what Benjamin Graham famously termed the margin of safety. The margin of safety is a crucial concept flowing directly from the focus on intrinsic value. It's your buffer against the uncertainties inherent in investing. Since estimating intrinsic value involves assumptions about the future, which is inherently uncertain, and potential errors in analysis, you don't want to buy an investment when the price is merely equal to your value estimate. You want to buy it when the price is substantially below your estimate. Imagine estimating a bridge can hold 10 tons. You wouldn't drive a 9.9-ton truck over it. You'd want a significant margin for error, maybe driving nothing heavier than 6 or 7 tons. Similarly, if you estimate a stock's intrinsic value is $50 per share, you wouldn't rush to buy it at $49. A value investor would look to buy it perhaps only when the price drops to $35 or $30, providing that cushion, that margin of safety. This protects you if your value estimate was too optimistic or if the company encounters unforeseen difficulties. It's buying insurance against being wrong. Now, again, you might be thinking, calculating discounted cash flows, analyzing balance sheets? That's beyond me. And for many individual investors relying on diversified funds, calculating the intrinsic value of individual stocks isn't necessary. However, understanding the principle is still vital. It cultivates a crucial investing mindset. You shift from being a price taker, just accepting whatever the market offers, to being a value assessor, judging whether the price offered represents a good deal relative to underlying worth. Even if you invest through funds, understanding this principle helps. You avoid chasing hot funds that have become potentially overvalued after a strong run. It encourages you to look for funds investing in areas of the market that might be temporarily out of favor but possess solid long-term fundamentals. It helps you appreciate strategies that prioritize buying good companies at reasonable prices, rather than just buying what's popular. This principle is inextricably linked to Principle 2, understand what you own. You cannot possibly estimate the intrinsic value of a business if you don't first understand how it operates, its competitive advantages, and its financial health. Understanding provides the foundation for the valuation judgment. It also requires the patience discussed in Principle 1 and reinforced in Principle 6. Sometimes the market takes a long time to recognize the true value of an undervalued company. Reflect on past purchases. Think about the last significant investment you made, stock, fund, maybe even a major purchase like a car. Was your decision driven primarily by the price, it seemed cheap or it was going up, or by an assessment of its underlying value, quality, features, long-term potential relative to the cost? Practice value assessment. Try this exercise with Everyday items. Look at products in a store. What's the price? What do you think its actual value is to you, considering its quality, utility, and alternatives? This helps train your value muscle. Explore simple metrics. Use with caution. While not a substitute for deep analysis, you can learn about simple valuation metrics like the price-to-earnings, PE ratio, or price-to-book, PB ratio. Understand what they measure, price relative to earnings or book value, and how they can be used as part of a broader assessment to compare a company's valuation to its peers or historical average. But never rely on one metric alone. Seek value-oriented resources. If interested in individual stocks, explore resources, books, websites, investment audiobooks dedicated to value investing to learn more about assessment techniques. Key takeaway for this chapter: don't be hypnotized by the flickering stock price. Focus on intrinsic value. Strive to understand the underlying worth of an investment based on its business fundamentals, its assets, earnings power, cash generation, and growth prospects. Seek to buy only when the market price offers a significant discount to your estimate of that value. Demand a margin of safety. This disciplined, value-driven approach, whether applied to individual stocks or fund selection, helps protect you from overpaying, reduces risk, encourages rational decision-making, Principle 5, and lays the groundwork for superior long-term investing returns on your journey to financial freedom. It shifts your investing mindset from speculation to ownership. Chapter 5, Principle 5, Avoid emotional investing. We've alluded to this throughout our discussion, but principle number 5 warrants its own dedicated focus because, frankly, it's the treacherous reef upon which countless investment plans crash. This principle addresses the internal battleground. Avoid emotional investing. After all the analysis, planning, and understanding, the single greatest threat to your long-term investing success might not be a market crash, a recession, or picking the wrong stock. More often than not, the biggest enemy stares back at you from the mirror. It's our own deeply ingrained human emotions, primarily the powerful duo of fear and greed, that can systematically sabotage even the most well-intentioned investing mindset and financial plan. The fascinating field of behavioral finance specifically studies how psychological biases, emotions, and cognitive errors impact our financial decisions, often leading us to act irrationally against our own best interests. Let's explore two of the most potent emotional traps in investing: fear, panic selling. When markets experience sharp, sudden declines, a correction or a crash, the headlines turn alarming, portfolio values plummet, and the primal instinct of fear kicks in. The overwhelming urge is often to sell everything to stop the bleeding, to escape the perceived danger. This feels like taking control, but it usually achieves the exact opposite. Selling in a panic locks in losses, often near the market bottom, and prevents participation in the eventual recovery. Fear makes you violate the cardinal rule: buy low, sell high. Instead, it compels you to sell low. This emotional response is deeply wired. Our brains evolved to react quickly to perceived threats, but that instinct serves us poorly in modern financial markets where volatility is normal. Greed, FOMO, fear of missing out. The flip side of fear is greed, often manifesting as FOMO. When markets are soaring, when a particular stock or sector, like tech stocks in a boom, or perhaps even real estate in certain cycles, seems to be making everyone else rich overnight, the temptation to jump on the bandwagon becomes immense. You hear stories of easy money, see neighbors upgrading their cars, and feel a desperate urge to get in on the action before it's too late. This often leads investors to pile into assets after they have already experienced significant run-ups, buying at inflated prices near the market top, just before a potential correction. Greed, or FOMO, makes you buy high. These two powerful emotions are constantly amplified by the relentless 24/7 financial news cycle and the echo chambers of social media. Market noise, the endless stream of predictions, hot tips, expert opinions, often conflicting, and sensationalized headlines, creates a pervasive sense of urgency. It pressures you to do something, to react now, even when the most rational course of action, according to your carefully crafted long-term plan based on principles like understanding value, P4, and diversification, P3, might be to simply sit tight and do nothing. It preys on our desire for certainty in an uncertain world, pushing us towards impulsive actions. Believe me, I understand this battle intimately. I've felt that cold knot of fear in my stomach watching hard-earned investment values evaporate on screen during a market downturn, even when intellectually I knew I owned good assets for the long term. I've felt that pang of envy and the what-if questioning when seeing others seemingly profit wildly from a speculative trend I chose to avoid based on my principles. Resisting these powerful emotional pulls isn't easy. It requires conscious effort, discipline, and importantly, preparation. It's not unlike the emotional stress many people feel when dealing with significant debt, especially high-interest credit card balances. That feeling of being overwhelmed, the anxiety about making payments, the desire for a quick fix, these are powerful emotions that can cloud judgment. Just as a structured plan like the debt snowball provides a clear path and psychological wins to manage debt emotions, a clear investment plan provides an anchor against market emotions. You might be sitting there listening, nodding along, but thinking, okay, I get it, fear and greed are bad, but how do I actually stop feeling them? How do I control my emotions when my life savings seem to be on the line? That's the million-dollar question. And the answer isn't about becoming a robot, devoid of feelings. We're human. Emotions are part of the package. The goal is not to eliminate emotion, but to recognize its influence and prevent it from hijacking your decision-making process. It's about building systems and mindsets that act as circuit breakers between feeling an emotion and acting on it impulsively. Here are concrete strategies to build emotional resilience in your investing. Have a written investment plan, your anchor. Before you invest a single dollar, write down your financial goals, your chosen long-term strategy, including your target asset allocation diversification approach, P3, your criteria for buying, selling, perhaps based on value, P4, or rebalancing needs, P6, and crucially, how you plan to react or not react during market volatility. What will you do if the market drops 10%, 20%, 30%? Having this pre-committed, strategy acts as your rational guide when emotions run high. Review it periodically. Automate your investing. Set up regular automatic contributions from your bank account or paycheck into your chosen investments, like index funds in your retirement account or brokerage account. This technique, often called dollar cost averaging, forces discipline. You invest the same amount regardless of market highs or lows, taking emotion out of the timing decision. It aligns perfectly with the habit to save and invest consistently from your budget. Limit your exposure to market noise. Stay informed about major economic trends, but drastically cut down on consuming daily financial news, watching stock tickers constantly, or engaging in speculative online forums. Most of it is noise designed to provoke clicks and emotional reactions, not provide actionable wisdom. Schedule specific limited times to check market news if you must. Focus on what you can control. You cannot control market movements, economic cycles, or news events. Trying to is a recipe for frustration. Focus instead on what you can control. Your savings rate, your investment strategy, asset allocation, your costs, choosing low-fee funds, your understanding of your investments, P2, and your own behavior. Adopt a long-term perspective, reinforce P1. constantly remind yourself why you are investing for goals that are likely years or decades away. Frame market downturns not as disasters, but as potential opportunities to buy assets at lower prices if aligned with your plan and value assessment. P4. Seek perspective, not panic. During volatile times, resist the urge to make immediate decisions. Step away from the screen, talk to a trusted friend, family member, or ideally a calm, rational financial advisor, if you have one, who understands your plan. Sometimes just verbalizing your fears can diffuse their power. Practice delayed gratification. Wait 24 or 48 hours before making any non-emergency investment decision driven by strong emotion. Key takeaway for this chapter: your own behavior, driven by fear and greed, is often a greater determinant of your ultimate investment returns than the market's inherent ups and downs. Avoid emotional investing. Cultivate self-awareness to recognize when fear or FOMO is influencing your thoughts. Build discipline through a written plan, automation, and limiting exposure to noise. Anchor your decisions in logic, your long-term goals, and the sound principles of smart investing. Mastering your money mindset and emotional responses is paramount for navigating the investment journey successfully and achieving lasting financial freedom and wealth building. Chapter 6. Principle 6. Be patient, not passive. Our sixth principle introduces a critical refinement to the long-term approach we established back in Principle 1. It adds a layer of responsible oversight to patient endurance. This principle is be patient, not passive. We've thoroughly established the immense virtue and necessity of patience in investing. Resisting the urge to constantly tinker, letting compound interest work its quiet magic over years and decades, and riding out inevitable market fluctuations without panicking, Principle 5, are all hallmarks of a successful long-term investor. However, patience should not be confused with complete neglect or apathy. Simply buying some investments and then sticking your head in the sand for the next 30 years is not smart investing. That's being passive, potentially even negligent. True stewardship of your financial future requires a balance, enduring patience combined with periodic, thoughtful attention. Let's clearly distinguish between these two concepts. Patience, essential. This is the discipline to stick to your well-thought-out investment strategy, even when it's uncomfortable. It means resisting the temptation to chase hot trends. Avoiding greed. P5, refusing to sell quality investments during market downturns simply because their price has dropped. Avoiding fear. P5, and giving your chosen assets sufficient time for their intrinsic value. P4, to potentially be recognized by the market, and for compound interest. P1, to generate meaningful growth. It's about trusting the process over the long term. Passivity, potentially harmful. This is the state of completely ignoring your investments once they are made. It means failing to periodically review your portfolio to ensure it still aligns with your goals and risk tolerance. It means being unaware if your initial diversification, P3 strategy, has been thrown wildly out of balance by market movements, e.g., stocks soaring while bonds lag, leaving you unintentionally overexposed to stock market risk. It means failing to notice if the fundamental reasons you invested in a particular company or fund have dramatically changed for the worse, violating Principle 2. Passivity is letting your financial plan drift rudderless. Think back to our garden. Analogy from Principle 1. Patience is letting the plants grow without constantly digging them up to check the roots. Being not passive is the act of responsible gardening, periodically checking for invasive weeds, investments that have fundamentally soured or no longer fit, ensuring the different plant types are getting the right amount of water and sunlight relative to each other, rebalancing your asset allocation, pruning dead branches, selling investments where the original thesis is broken, and perhaps adding fertilizer, making new contributions according to your plan. It's engaged oversight, not obsessive meddling. So what does this patient, not passive approach look like in practical terms for the average investor focused on long-term wealth building? It primarily involves conducting periodic reviews of your portfolio and overall financial situation. This doesn't mean daily or even monthly check-ins, which can feed emotional reactions. P5. For most long-term investors, a review once or twice a year is generally sufficient. Here's what these periodic reviews should ideally cover. Check your asset allocation, rebalancing. Over time, different asset classes perform differently. If stocks have had a strong run, they might grow to represent a much larger percentage of your portfolio than you initially intended, while bonds might shrink proportionally. This portfolio drift can leave you taking on more risk than you're comfortable with or than is appropriate for your goals, like if you're getting closer to needing funds for buying a house or retirement. Rebalancing is the disciplined process of selling some of the assets that have grown significantly, selling high, and using the proceeds to buy more of the assets that have lagged, buying low, to bring your portfolio back to your original target. Diversification percentages, P3. This might feel counterintuitive, selling winners and buying losers, but it's a crucial risk management technique that enforces discipline. Review individual holdings, if applicable. If you own individual stocks rather than just broad funds, your review should include a quick check on their fundamental health. Has anything drastically changed regarding the company's business model, competitive position, management, or financial stability? Principle 2. Did they take on an alarming amount of new debt? Is the original reason you invested still valid? You're not looking for reasons to trade. You're looking for significant red flags that might warrant selling and redeploying the capital elsewhere, perhaps because its intrinsic value proposition has genuinely deteriorated. Assess fund performance, relative basis. If you invest through mutual funds or ETFs, briefly compare their performance to their relevant benchmark index, e.g., comparing your S&P 500 index fund to the S&P 500 index itself, factoring in fees, or peer group. Consistent, significant underperformance might warrant investigation. Is the manager drifting from the stated strategy? Are fees too high? But avoid jumping ship based on short-term results alone. For index funds, the main check is that they are tracking their index closely and fees remain low. Revisit your goals and personal situation. Life happens. Your income might change, your family situation might evolve, marriage, children, your risk tolerance could shift, or your major financial goals, like retirement or buying a house, might become closer or further away. Your periodic review is the time to ensure your investment strategy still aligns with your current life circumstances and future aspirations. Does your required savings rate from your budget need adjustment? Do you need to update your insurance coverage, potentially impacting available investment cash? Is the progress on your debt snowball on track, freeing up future funds for investing? The key here is balance. You want to be engaged enough to be a responsible steward of your assets, but not so engaged that you fall back into emotional tinkering, P5, or market timing attempts. The goal of the review is not to chase performance or make predictions. It's to ensure your existing plan remains sound, aligned, and appropriately risk-managed. For many investors, using a simple portfolio of low-cost index funds according to a target asset allocation, the main action during a review might simply be rebalancing if needed and confirming their savings contributions are on track. Key takeaway for this chapter: marry long-term patience with disciplined periodic oversight. Be patient, not passive. Trust your strategy and let your investments compound over time. P1. But don't completely neglect them. Schedule regular reviews, e.g. annually, to check your asset allocation, rebalance if necessary, briefly assess your holdings for fundamental deterioration, especially individual stocks, and ensure your overall plan still aligns with your evolving life goals, like financial freedom, retirement, or maybe funding education alongside buying a house. This active stewardship, distinct from hyperactive trading, ensures your smart investing plan remains on course and resilient over the long haul, maximizing your chances of successful wealth building. Chapter 7. Principle 7. Learn from the best and keep learning. We've reached our 7th and final golden principle. This one acts as both a capstone, tying everything together, and a perpetual engine for your continued growth and success as an investor. It's perhaps the most empowering principle of all. Learn from the best and keep learning. The journey towards financial freedom and mastering the art and science of smart investing is not a destination you arrive at one day and then stop. It's a continuous process of learning, refinement, and adaptation. The good news is you don't have to figure everything out from scratch through painful trial and error. There's a vast wealth of knowledge and wisdom accumulated by brilliant minds and experienced practitioners who have navigated the markets before you. Your task and opportunity is to tap into this collective intelligence, stand on the shoulders of giants, and commit to being a lifelong student of your own financial well-being. So, what does this commitment to continuous learning entail? Study the masters. Immerse yourself in the philosophies and writings of legendary investors. We've repeatedly mentioned Warren Buffett. Reading his annual letters to Berkshire Hathaway shareholders is like receiving a multi-decade masterclass in long-term, value-oriented thinking, P4, business analysis, P2, and rational temperament, P5. Explore the work of John Bogle, the founder of Vanguard, whose relentless advocacy for low-cost index fund investing revolutionized the industry and made effective diversification, P3, accessible to ordinary people. Learn from Peter Lynch, author of One Up on Wall Street, who championed the idea of investing in companies you understand from your everyday life, P2. Investigate Benjamin Graham, the intelligent investor, Buffett's mentor, the father of value investing and the margin of safety concept, P4. Understand the insights of Pat Dorsey on identifying companies with durable competitive advantages, or economic moats, P2. Learning their frameworks, their successes, and their admitted mistakes provides invaluable perspective. Read widely and listen. Devour quality investment audiobooks and classic finance books. Explore topics beyond just stock picking. Understand behavioral finance to better manage P5, basic economics, inflation, interest rates, economic cycles, different asset classes in more detail, bonds, real estate investing strategies, perhaps even alternatives if appropriate later on. Look for reputable book summaries on platforms like BookTube or dedicated finance channels, but always prioritize depth over just headlines. Understand personal finance fundamentals. Effective investing doesn't happen in isolation. Deepen your understanding of related personal finance pillars. How does effective budgeting create the surplus cash needed to invest consistently? How does managing and eliminating high-interest debt, perhaps via the debt snowball, improve your financial health and free up capital? What role does adequate insurance, health, life, disability, property, play in protecting your financial plan from unforeseen catastrophes? How do taxes impact your investment returns, and what strategies exist for tax efficiency, like utilizing retirement accounts? A holistic understanding makes your investment plan more robust. Follow credible sources. Selectively, Identify a handful of reputable financial news outlets, economic commentators, and finance education websites or podcasts, known for thoughtful analysis rather than hype or constant predictions. Be discerning. Learn to differentiate between insightful commentary and mere market noise or sales pitches. You might even listen to different perspectives, like comparing the holistic financial planning advice on the Dave Ramsey Show, often emphasizing debt elimination and specific fund types, like the 4 types of funds, with channels focusing purely on portfolio construction or economic analysis to form your own well-rounded view. Critically evaluate all sources. Learn from your own experience and mistakes. Keep an investment journal, optional but helpful. Record why you made specific investment decisions. When things go right, understand why. More importantly, when an investment doesn't work out as expected, don't just sweep it under the rug. Analyze what happened. Was it bad luck? Did you misunderstand the business? P2. Did you overpay? P4. Did you panic sell? P5. Did you fail to diversify properly? P3. Extracting lessons from mistakes transforms them from losses into valuable tuition paid to the school of hard knocks. I can tell you from personal experience, even after many years deeply involved in finance, the learning never stops. Markets evolve, new technologies emerge, economic conditions shift. New academic research provides fresh insights into investor behavior and market dynamics. Maintaining a sense of curiosity and humility is crucial. Recognize that you don't know everything, and you never will. Even the best investors make mistakes. The key difference is that successful investors learn from those mistakes and continuously refine their process. They don't let ego prevent them from acknowledging errors or adapting their approach when warranted by evidence or changing circumstances. This commitment to learning isn't about becoming a financial academic or spending hours each day reading dense reports, unless you enjoy that. It's about developing your financial intelligence, your ability to make sound judgments about money, risk, and value steadily over time. It's about understanding how to make money work for you intelligently. Schedule learning time. Just as you might schedule exercise, dedicate a small amount of regular time, e.g., 30 minutes a week, 1 weekend morning a month, specifically for financial learning. Pick your next resource. Choose one quality investment audiobook, book, or online course to engage with over the next few months. Identify your trusted sources. Consciously select 2 to 3 credible financial writers, publications, or podcasts you find insightful and relatively unbiased. Unsubscribe from or ignore the noisy, speculative ones. Reflect and analyze. After your next portfolio review, P6, or if you make a specific investment decision, take 10 minutes to jot down your rationale. Revisit it later to see how your thinking holds up. Discuss carefully. Engage in thoughtful discussions about finance and investing with trusted, knowledgeable friends or mentors, avoiding those prone to hot tips or panic. Explaining concepts to others is a great way to solidify your own understanding. Key takeaway for this chapter: your greatest asset in achieving long-term investing success and financial freedom is your own knowledge and wisdom. Learn from the best and keep learning. Embrace continuous finance education by studying successful investors, reading widely, understanding the interplay with personal finance fundamentals like budgeting and debt management, following credible sources critically, and learning from your own experiences, especially mistakes. This ongoing commitment to sharpening your investing mindset and financial acumen is perhaps the highest return investment you can ever make on your journey to sustainable wealth building. Conclusion and action steps. So we've journeyed together through the 7 golden principles of smart investing. Let's quickly recap these pillars designed to guide you towards building lasting wealth and achieving financial freedom. Think long-term. Harness the incredible power of compound interest by giving your investments the time they need to grow. Focus on decades, not days. Understand what you own. Go beyond ticker symbols. Invest like a knowledgeable part owner in businesses or fund strategies you comprehend. Diversify intelligently. Spread your investments wisely across different asset classes, geographies, and sectors to manage risk and build resilience. Don't put all your eggs in one basket. Focus on intrinsic value. Seek to buy quality investments when their market price is reasonably or significantly below their underlying worth. Demand that crucial margin of safety. Avoid emotional investing. Recognize and manage the powerful influences of fear and greed. Anchor your decisions in logic and your written plan, not market noise or herd behavior. Be patient, not passive. Combine a steadfast long-term view with periodic disciplined oversight and rebalancing to keep your plan on track and aligned with your goals. Learn from the best and keep learning. Commit to lifelong finance education. Study successful investors, read widely, learn from mistakes, and continuously sharpen your financial intelligence. These principles, as you've heard, aren't complex algorithms or secret formulas. They don't require predicting the future. But they do demand discipline, patience, emotional resilience, and a consistent, rational investing mindset. They provide a robust framework, a reliable map, for navigating the often confusing world of the stock market and other investments wisely, helping you avoid common pitfalls and steadily build wealth over time. It's crucial to remember, as we've touched upon throughout, that successful investing rarely happens in isolation. It stands firmly upon a foundation of solid personal finance habits. This means having a functioning budget that tracks income and expenses, allowing you to consistently save, effectively managing your day-to-day money and maintaining positive cash flow, having a plan to eliminate and avoid high-interest consumer debt, perhaps using focused strategies like the debt snowball to build momentum and psychological wins. Getting rid of expensive credit card debt is often the best investment you can make initially, protecting your financial life with adequate insurance, health, disability, life, property, to prevent unforeseen events from derailing your savings and investment plans. Building and maintaining an emergency fund, typically 3 to 6 months of essential living expenses in safe, accessible cash, so you're never forced to sell investments at inopportune times to cover unexpected costs. These foundational elements provide the stability, the surplus capital, and the peace of mind necessary to invest for the long term without being derailed by life's inevitable curveballs or the need to access funds prematurely for goals like buying a house. Your journey to becoming a more confident, successful investor truly accelerates now with the choices you make moving forward. Listening to this audiobook is an important step, but action is where transformation happens. So I ask you, what is one principle from our discussion today that resonated most strongly with you? What is one concrete action you can take this week to begin implementing that principle more effectively in your own financial life? Perhaps it's finally sitting down to write out your investment plan to combat emotional decisions, Principle 5. Maybe it's dedicating an hour to better understand just one key holding in your portfolio, Principle 2. It could be setting up automatic, monthly investments, no matter how small, to harness dollar cost averaging and enforce discipline, linking Principles 1 and 5. Or maybe it's choosing your first quality investment audiobook or book to deepen your knowledge, Principle 7. Start small, but start now. To support you in putting these principles into practice, I encourage you to mention specific action, e.g., download the companion PDF worksheet available at your link, or re-listen to the chapter that feels most relevant to your current situation, or visit our website at your link for further resources. You'll find that continually exposing yourself to reliable finance education sources, whether they focus on wealth-building strategies, success habits, money mindset, or even foundational topics like budgeting and debt management discussed on shows like The Ramsey Show livestream, reinforces these concepts. Find credible voices that resonate with your long-term vision. If you found this audiobook summary valuable in clarifying the path to smart investing, please consider subscribing for more content designed to empower your financial freedom journey. We explore investing for beginners, advanced strategies, stock market insights, and the crucial psychology of wealth. Your engagement, perhaps a like or a comment sharing your biggest takeaway or a question, helps others discover this guidance too. Remember, building significant wealth through smart investing is not reserved for the ultra-rich or financial wizards. It is achievable for ordinary people willing to learn, apply proven principles consistently, and exercise discipline over the long term. It requires patience, yes. It requires emotional control, absolutely. But the potential rewards, achieving financial freedom, securing your future, having the resources to live life on your terms, perhaps comfortably buying a house or retiring early, and creating opportunities for yourself and your loved ones, are profoundly worthwhile. Take these 7 principles to heart. Let them be your compass. Start today, stay consistent, trust the process, and keep learning. You possess the capability to build the financial future you desire. Thank you for listening. The 7 Golden Principles of Smart Investing. Audiobook. For Building Wealth, written by Peter A. Saul, published by Audiobooks LOA.